Hello and welcome. My name is Benoit Poliquin. I'm the founder and one of the portfolio managers here at Exponent Investment Management. And you're watching the second quarter of 2022 quarterly review. This quarter, we're changing things up a little bit. We've split the review into two videos. One more qualitative, really, if you want to know what happened and why it's important, is this video that you're watching. And then we've created another video where we're going through the more quantitative aspects, the charts and that sort of thing, for you investing nerds, if you will. So thanks again for watching. As always, we'd love to hear your feedback, and talk to you soon. Thanks. So basically, at the end of the second quarter, we've gone from greed to fear in 180 days. That is the theme of this quarter: emotions. So this is the performance that we had at the end of 2021. Everything was great. The quarterly performance was awesome. Everything was up, save for emerging markets, which are basically 50% China, and China was having a tough time. So that was the only negative print. Really, oil prices were up for the year. Even gold was up. Rates were coming up, but they were still quite low. So everyone's feeling confident. I would say even a little greedy. The feedback we were getting from some clients was, we're not making enough money. There's too much cash on the balance sheets. Why don't we own some of these high flying stocks, so on and so forth. Many investors, and if you're reading the media, and we'll go through some of the headlines in the next slide, but it was kind of a risk-free world and certainly a worry-free world. These are some of the headlines we were seeing. These are the headlines taken from the Wall Street Journal at the end of 2021. There's some Coinbase CEO buying a house for $133 million. Now, no one does that at the bottom of the market. Big gains in the S&P 500. Inflation, it still is transitory, apparently, according to this commentary. Startups just booming. Private equity. Everyone wants private equity. The huge volumes and huge valuations. More dollars coming into SPACs and startups, and just almost a euphoric mood. Low rates will do that to investors. Fast forward to today. This is the end of second quarter of 2022. Basically, outside the US dollar, everything's basically in the oil price, everything's negative. Rates are certainly much higher. So with higher rates comes lower valuations, and we'll get to that in a minute. But basically, if you stop and think about it, most assets are use borrowed money to purchase. And so if the cost of this borrowing goes up, then the value of the asset you're buying, whether it's a business, a house, or a car, well, it has to come down a little bit. So in that environment, especially when people are seeing negative prints even on a 12-month basis, it leads to an emotional reaction: pessimism, fear, doubt, maybe even a little rudderless. Don't really have sort of a direction, a sense of direction, or a plan. And so all of this is predicated on the fact that interest rates have risen substantially in the past year. Central banks are getting out of being economic agents. At the end of the day, that's what it means. So interest rates need to go back to where they were before the pandemic. So there's the most recent headlines from the end of June. So you've got worst half since 1970, cooling consumer spending. Obviously, if your portfolio has gone down and if cost of living has gone up, there is a chance, or a very strong chance, that basically your spending will be adjusted downward. The Fed is still feeling the inflation heat. Crypto basically blew up. A lot of NFTs. No one's talking about NFTs anymore. Christie's last year sold 150 million worth of NFTs. This year, half the year, basically $9 million. Or $4.5 million annualized. That's a $9 million print. So basically, down substantially, almost 90%, over 90%. Crypto hedge funds blowing up. Liquidation is a more polite word of basically saying a blow up in crypto from a fund perspective or hedge fund perspective. So what happened? What's next, more importantly? So what we've got here is the S&P 500 and the TSX for the past over 2 years. So these are the levels pre-COVID. We see the COVID plunge basically in a month's time. And then right around here, central banks the world over, as well as governments, decided to spend money, a lot of money. The numbers are astronomical. They were trying to avoid a replay of the 0809 great financial crisis, where the financial system ground to a halt. So asset prices the world over got inflated. Even though we were all locked down, asset prices continued to increase. And that led to animal spirits chasing. And this continued. And then we call it the vaccine Monday back in November when the vaccine was discovered. And from there on, you had sort of a resolution to the pandemic combined with a financial system flooded with money. And the central banks, as I said in the earlier chart, basically decided to get out of stop being economic agents. So they're draining all of the liquidity. Now, governments haven't cut their spending yet, but central banks are trying very hard to harness all that capital that went into the financial system, because when there's too much capital in the financial system, it leads to inflation. Inflation of assets, which are really, it's an enjoyable feeling, but also inflation of costs, of inputs, which leads to inflation in terms of consumption costs. So what's next? So a lot of clients are thinking, is it over? The truth is, we don't really know if it's over, but we certainly can say that it looks like we're closer to the end than certainly the beginning. So how do we know this? Well, again, if you're looking at capitulation, emotion, disgust, if you just look in your circle of friends or headlines that we showed you, there's a lot of capitulations. As interest rates have risen, GICs are now an interesting, compelling argument now, especially in the face of negative returns. A year ago, no one would have bought GICs. Now, some people are inquiring about GICs. It's an interesting observation. Now, I've found that I put up these. Some of you might be wondering, what are these things? Why am I having two pictures of birds here? Well, I'm trying to illustrate 2 points. I found that there are two kinds of investors in the 20 plus years I've been doing this. I call them the hawks and the canaries. So the hawks you never hear from. They don't make the headlines. They're not on CNBC or BNN. And they're basically, you're lucky to basically read anything about what they're doing. But they tend to swoop in at the most unexpected times. And they do it in such a way that it's really kind of awkward, if not, it's hard to understand. Only in hindsight do you understand what the move was. So, obviously Warren Buffett comes to mind, but there's many other investors that fall into the hawk category. And then you've got the canaries. So they're always on TV. They're always in the headlines. And they're always chirping. And they're usually chirping when there's absolutely nothing to worry about. So they're the ones that are trying to create something out of nothing. Now remember, canaries are used as an alarm for danger. So the fact is, these canaries, they stop chirping basically when things are tough. So basically, canary investors tend to buy high and sell low, while hawk investors do the exact opposite. So it's really hard to be a hawk because a lot of times you're doing nothing. You're just watching. And then you swoop in and you take advantage of the situation. Whereas canaries chirp all the time. You hear them all the time, except when times are tough. So remember, the two emotions you want to see at the very bottom are disgust and distrust. And many of the headlines are pointing to those two emotions. So what does a recovery look like? You need 3 things. Low expectations. When we argue, we're already there. Low valuations. By many metrics, we're there. Could valuations get lower? Absolutely. There's an expectation that the next earnings season will be horrendous. Remember, companies tend to want to write off much more than they basically want to maximize their write-offs when everyone is expecting a bad quarter. And you also need a central bank pivot. You need the central bank to stop or to indicate or announce that they've almost done raising rates, or there's a path to central banks stopping to raise rates. Now, there's a few indicators that you can use to see where you are in terms of a market bottom. So we've got the PR Fisher. I'll skip the definition of them, but basically what I've done is look at past market bottoms since 2013. Those are the blue lines. And as you can see, markets tend to have very volatile moves. And think of these indicators as dashboards, the dials on the dashboard. Now, these indicators don't work 100% of the time, but they work more often than not. So one of the indicators I like to look at is the Fisher bottom indicator. And it tends, when that indicator is basically below 30, which is the horizontal blue line here, it tends to coincide with market bottoms most of the time. But 1, 2, 3, 4, and 5. Now, the problem with 2015 and 2016 is that the market traded in a box for a long period of time. And that's another interesting point here. Markets don't necessarily have to fall very much. They can stay stagnant for 18 months, which is a concept that the headlines are talking about, is that a market basically can back off. Let's just say we back off here to 3,800, 3,500. Basically, we want to go back to somewhere around where the pre-COVID levels were, but we can stay there for 6, 12, 18, even 24 months. The markets have done that a lot of times in the past. So markets can be sometimes like a V, but sometimes they just can be a flat line. We'll call that trading in a box, where the markets will trade within a range for up to 24 months. So you have to go through short-term losses or pain and long-term gains. Now remember, the only loss is when you actually do sell. But here's 3M, one of the perennial boring stocks. The kind that, people say you want to buy them because they're widows and orphan stocks. Well, they do go down. They go down with the market as well. They go down less, but they do go down. So there are periods where they'll trade in a box, went down, and then basically this stock, you didn't make any money until 4 years after the peak in 2008. So it can take a while for the returns to happen, but those dividends kept coming in and they increase over time. And over the long term, let's just say you bought this stock sometime in 2008 or 2007, the stock would have doubled since. A very healthy return if you combine the dividends and appreciation, but you have to be willing to live through the gyrations. Another example would be bank stocks. When the bank stocks are going up, many headlines will say, just buy Royal Bank or buy Scotiabank and go to sleep. Unfortunately, bank stocks are volatile, but over the long term, this volatility tends to be muted. At the bottom, we have our dividend chart. So the dividends continue to go up over time. And if you bought a stock back in 2008, there'll be periods of time up to 2 years where the returns will be underwhelming, if not negative. But as you extend time, that's when the long-term gains start to appear. So emotionally, we need to focus on the real focus of why people invest. Why are you investing? Your longevity. You want to make sure that your capital is there for when you need it, 5, 10, 20, 30 years from now. And that capital needs to keep its purchasing power. That's really why most private investors will invest. And finally, if you're past that, you're also investing for your financial legacy, the next generation, or perhaps gifts you want to make sometime in the future. So those 3 arrows are the arrows that you're really trying to direct. You've got to divorce yourself from the emotional roller coaster ride that can be equity investing. And these past 6 months have certainly been a difficult or a scary roller coaster. Thank you for watching. As always, we'd love to hear your questions or comments, and we'll talk to you soon.